Hey guys, what's up? Alec back with the daily stock market, and today we're going to talk about 3 to 5 different stocks to have on your watch list for this week. First, we're going to dive into Affirm. We're going to go over some reasons why I think they're a great long-term hold, and then we're going to go over a few different stocks, so make sure you stay to the end and you watch this full video so that way you're prepared for the trading week that's coming ahead. Remember, the stock market is closed for President's Day on Monday, but it'll be back open on Tuesday. So Affirm is down to $36 per share, down 18% just in the last week, down 43% in the last month, now down 73% in the past 3 months. So if you ever see a stock down 60% or more in the past 3 months, you know that their stock has been absolutely decimated. We've seen them as low as $48 per share in the past, but right now they're at new all-time lows. They've never been this low before. You can also see that they just recently reported earnings. They're a negative earning company, and they missed their EPS for the last 4 quarters in a row, so it's not surprising they did miss again this quarter. We also see a market cap of $10 billion with a 52-week high of $176 and a 52-week low of $35 per share. So that gives you around a 300% upside to new all-time highs. Actually more than 300. It's like 400% upside to new all-time highs. Okay, I got some bullet points here on Affirm. Let's go over some risks on Affirm first, because there's a lot of risks with Affirm. So you'll see warning: Affirm is high risk of performing badly. Affirm has characteristics which have been historically associated with poor future stock performance. Affirm has declining growth and inferior profitability when compared to the information technology stocks, to the point that it gets a strong sell rating from our quant rating systems. But keep in mind, they're also comparing Affirm to well-established companies in the IT space like Apple and Amazon. The company has an EPS forward long-term growth 3 to 5 year compounding annual growth revenue of negative 34%, while the IT sector has a median of 15%, which again, they're comparing to some well-established companies. Affirm isn't established yet. That's why there's a lot of risks, and it's a growth company that you're investing in with Affirm, and the business model hasn't been too popular in the United States, but the next 1 to 2 to 3 years, the business model can become more widely adapted. So let's continue. Given Affirm's projected growth, a premium is deserved. The question is how much. Despite being down almost 75% from all-time highs, shares remain about 4x more expensive versus what I believe to be relevant peers. So even down 75%, some analysts still think that Affirm is overvalued. So we don't have to go too much deeper into Affirm. All you basically need to know is that you're investing in a very high risky stock that could potentially still be overvalued even at $37 per share. However, on average, the analysts have them about $84 per share in the next 6 to 12 months. So you do have an extreme upside with something like Affirm. And that's obviously the nature of growth investing. There's high risks, but there's high rewards. You know, if you can get 125% upside over the next 12 months, I think you're going to be doing just fine. However, there's no guarantees that Affirm can return that. If you're going to be holding Affirm, what I'm personally doing is definitely not buying for the short term. I'm going to be holding Affirm for at least 12 to 24 months. Now, the next stock we're going to be talking about in this video is going to be Matterport. All right. Most of you guys know them. Most of you guys love them. They're only $6 per share. So I'm also going to be making a video, the best stocks under $10 per share. Matterport's going to make that video. So make sure you're subscribed with post notifications on so you get alerted when I put out that new video of best stocks under $10 per share. So let's jump into Matterport, down 44% in the last month. And again, if you go out to the last 3 months, just like Affirm, you see them down 76% in the last 3 months. And from highs, they're nearly down 80%. Okay, this was a stock that was as high as $32 per share in the past. You can see it just IPO'd in 2021 at the beginning. So it hasn't been on the stock market too long. It hasn't posted that many earnings that, a lot of analysts haven't been tracking it for a long time. So let's kind of go over and dive a little bit deeper into Matterport. But real quick, you'll see I have 76 shares at an average cost of $6.50 per share. So I want to lower my average cost. And personally, I'm buying anything under $6 per share. I want to buy closer to $5 per share. All right, and what we'll see if you scroll down is a $1.6 billion market cap. So it's still a very, very small company, just like Affirm. basically the same market cap on Affirm as well. You'll also see they've only posted 3 earning results, and they've basically been right on target every time. Next quarter, they can produce a positive earnings, which would be huge for the company. They're getting closer and closer to that profitability mark. So here we'll see in the aftermath of Meta announcement for the metaverse, more investors have realized potential of Matterport Holdings as one of the leading developers of 3D capturing software, looking to combine some of its software with the latter artificial intelligence, machine learning, analyst capabilities. In partnerships with Midland Holdings will allow customers to experience the metaverse concept of property shopping and designing with virtual furniture that can be purchased through Midland's partnerships. However, Matterport has been hit by a chip shortage and the global supply chain issue, with the product revenues linked to the Pro 2 3D cameras declining by 23% quarter over quarter just from the chip shortages. Okay, so obviously, a huge investment thesis on this one is going to be believing in the metaverse. Nonetheless, we expect the decline to be moderated by the increase in subscription fees as more Android smartphone users download its newly launched app, Matterport for Android. In addition, with the recent releases of its app Matterport for Android, we expect more to buy into the subscription service given the convenience of a smartphone 3D capturing and the multiple benefits digital twins have to offer. So once they release that for Apple and iPhone, which is only a matter of time, that's not even in the investment thesis, so you have to think about that also. Matterport's revenue growth is hindered by global supply chain issues. In the last 2 years, Matterport reported excellent revenue growth of compound annual revenue growth of 55% from 46 million in 19 to 111 million in 21, and 21 total revenues also represented a remarkable increase of 29% year over year. In addition to Matterport's subscription revenues have seen a steady quarter over quarter increase from 7.5 million in first quarter 20 to 16 million in first quarter 21. In total, subscribers also increased 500,000. And take some time and look over the charts too. That's what I have in there. You can see the free subscription makes up a lot of it, and then the paid subscription is in the blue. Matterport reported excellent year-over-year growth. Its free and paid subscriptions at 25% and 213% respectively. However, its quarter-over-quarter growth is not so impressive. Given how the company has been affected by the global chain supply, Matterport recorded only an increase of 1.8% and 2% quarter over quarter for its paid and free subscriptions respectively. So that's obviously why you see the stock going down right now. It's not hitting those guidance numbers. It only gained 2% quarter over quarter when it was doing like 50% year over year. So is Matterport stock a buy? Matterport projected revenues and EBITDA margin. All right, here you can see some of the projections and the guidance. In the next 2 years, Matterport is expected to report excellent revenue growth at a compounding annual growth rate of 53%. However, Matterport guided annual revenues in the range of 125 to 135 million, lower than the consensus estimate of 160 million. Investors who add now must be aware that Matterport is not profitable yet and will only be EBITDA positive from 2024 onwards due to the massive research and development on expenses. However, we still expect decent growth moving forward given Matterport's guidance of 34% year over year subscription revenue growth to 82 million in 22. Matterport is currently trading at revenues of 12 times lower than its historical mean of 32 times. Consensus estimates also rate Matterport stock as attractive now given its undervaluation and future impact on the metaverse. Given the recent decline in tech stocks, Matterport is now trading at a 52-week low, so investors could take this opportunity to start loading up on a very cheap stock that's under $10 per share. This is a long-term hold. Again, I would probably consider holding at least till 2024 when they're a positive earning company. And this one has some huge potential in it as well. You can easily see 100 to 200% gains with something like Matterport in the next 1 to 2 years. Okay, next one up is PLTR, Palantir Technologies, down 26% in the last month, 49% in the last 3 months. So another stock that's absolutely decimated. And this one might end up on my stocks under $10 video as well. if it does go under $10 and into the $9 range. So you can see that the market cap on this one is still massive, 22 billion. All right, the 52-week high is about $30 per share, which is a 3x or 300% gain from current prices. Cathie Wood halves exposure in Palantir, dumps $140 million worth shares on Friday. Cathie Wood, led ARK Investment Manager, told on Friday, sold more shares of Palantir. Here we'll see Palantir submitted to its earnings card yesterday, which was Thursday last week. The business showed strong momentum in the fourth quarter, especially the private enterprise market. However, earnings came in below expectations, creating selling pressure. The drop created another buying opportunity near one-year lows. Shares of software company Palantir were brutalized on Thursday, although the firm submitted an earnings card that showed accelerating business growth and better customer monetization, especially in the markets for commercial clients. While losses were slightly higher than expected, investors seemed to overreact to Palantir's earnings. Shares of Palantir, after losing 16% yesterday, are a buy near one-year lows. Market overreacts. Shares of Palantir went into a deep dive yesterday, Thursday, after the software intelligence firm reported results that were better on revenues but missed on the bottom lines, which was the EPS, the net income. Palantir generated revenues of almost $500 million in the fourth quarter, showing a 34% year-over-year growth. Palantir's 21 revenue figure was $14 million for Q4, above the firm's guidance. Adjusted earnings were 2 cents per share, half of what the market was expecting. You'll see customer acquisition and commercial revenues momentum are accelerating. Palantir has earned a reputation for being a government contractor, which is at least partly deserved. Historically, Palantir has generated the majority of the revenue from government contracts. However, the software firm is seeing some real momentum resulting from the push into the private enterprise market. Palantir added 34 net new customers to its software platforms during the quarter and ended Q4 21 with a record numbers of paying clients. In fiscal year 21, Palantir tripled its commercial customer count to 147 year over year, with a net dollar retention rates, NDRR, being reported at 113%. Net dollar retention rates are used to measure how much more money existing customers spend on the platform over time. And then that brings us to guidance reaffirmed. Palantir confirms it expects for 30% long-term on top line growth, which would be revenue, with revenues of $1.4 billion in fiscal year 21. A 30% growth rate implies revenue of approximately $2 billion in fiscal year 21. I believe Palantir given the momentum in the commercial business, especially in the US, could see revenues of up to $2.13 billion, implying the top line growth of 38% in fiscal year 21. So this analyst thinks that they can easily beat on top line. All right. The firm also projects revenue of $443 million in the first year of fiscal year 22, implying a 2.3% quarter over quarter growth. So now we get to buy the drop, with $2.0 billion in revenues expected for fiscal year 22 at the minimum. Shares of Palantir have a market capitalization to sales ratio of 9.2x. Due to the large drop in pricing since November, Palantir's sales multiplier factor has been discounted about 60%. Okay, which seems to be an aggressive reaction. And you'll see the risks with Palantir. The biggest risk for Palantir, as I can see, is a slowdown in revenue and free cash flow growth, and related to that, a potential decrease in the firm's free cash flow margin. The company is adding new clients to its commercial business very rapidly, so the risk of occurring is probably rather low right now. However, the top line deceleration and lower cash flows would likely add pressure on Palantir's sales multiple factors. So you really want to watch the revenue growth with Palantir. Final thoughts: the 16% price drop in price that the shares of Palantir went through on Thursday is totally exaggerated. Palantir's commercial business shows a lot of promise, with more clients being added and revenue growth accelerating. Free cash flow could have been a little bit stronger, but the margin remains solidly above 20%, which is amazing. Because of Palantir's large drop in price, the shares are trading near a one-year low, 52-week low. the risk profile is now even more heavily skewed to the upside. So all the stocks we talked about in this video are risky, Palantir being the least riskiest in my opinion, and Affirm being the most riskiest stock in my opinion. These are all going to be typically longer term holds between 1 and 2 years, and I think Palantir under $10 per share is a great place to be buying for long-term investors. At least that's what I'm personally doing, and I'm looking to sell at least above $15 to $20 per share, looking for at least 100% gain in Palantir in the next 6 to 12 months. I hope you guys appreciate that video. Just smash a thumbs up on this video is all I ask if you enjoy this type of content. And if you want to join my close friends list, tell me that you just message me on Instagram. Tell me that you came from YouTube. You can read through these success stories. Success number 4, there's hundreds of success stories from clients. Success number 3, success number 2. We've filled up hundreds and hundreds of success stories in the past. So I definitely want you to be the next success story. And now is a great time to start getting in the stock market, buying stocks, because they are at low prices, and a lot of stocks right now are great deals, especially if you plan on holding for the next 6 to 12 months. Now is a great time to be adding to your portfolio and accruing some assets to your name. Leave a thumbs up, share with a friend if you want more videos like this, and I'll see you guys in the next video. Remember, don't time the market, buy the market. Peace.